Peter Spiller is one of the most experienced fund managers we have in the UK, having managed the London-listed Capital Gearing Trust since 1982. This long-only, multi-asset strategy has very successfully navigated several market cycles, and in today's episode, we catch up with Peter to discuss a variety of topical issues, including his inflation outlook, the important role that inflation-linked securities can currently play within asset allocation, the state of the London-listed investment trust sector, and of course, the potential implications of political change from elections in both the UK and the US. Welcome to the Investor Insights podcast, hosted by Killik Co. My name is Gordon Smith, and in each episode, I'll be interviewing portfolio managers from across the investment industry to gain from their expertise in the specialist areas in which they invest, and to question them on topical issues. You can access the full series of interviews via the playlist on the Killik Co YouTube channel, or by searching for Killik Co's Investor Insights on Spotify, where you can subscribe and be notified of future episodes. We hope you're enjoying the discussion so far, and you can get in contact with us about any of the topics discussed via the email address investorinsights@killik.com. Killik Co is an independently owned wealth manager which opened its first office in 1989 and provides services to help families save, plan and invest. And you can find more details on the unique ways in which we do that at our website killik.com. In today's episode, we were delighted to be joined by Peter Spiller, the CIO of CG Asset Management, a business he founded in the year 2000. Alongside his team, which includes CEO Alistair Lang and co-CIO Chris Clothier, the management team run a range of fund strategies, which include the London-listed Capital Gearing Trust, ticker CGT, as well as the open-ended CG Absolute Return Fund. The objective of both these strategies is to preserve and over time grow shareholders' real, as in inflation-adjusted wealth. They aim to do this through an investment approach which is value-driven, long-term, and places a strong emphasis on asset allocation as the primary tool for both capital preservation and superior long-run investment performance. The Capital Gearing Trust is also a fine example of an investment trust using a strong discount control policy to its advantage. The company provides liquidity within the market for both buyers and sellers at around the net asset value, or NAV, at any given point in time. The strong implementation of this policy has reduced share price volatility around the NAV, added to returns due to the accretive nature of issuance and repurchases, and enabled the company to grow in size over time, reflecting the good long-term performance of the strategy. This is a topic we delve into in more detail during our discussion. In part of this episode, Peter discusses the CAPE ratio, sometimes called the Shiller PE, referring to the cyclically adjusted price-earnings ratio, which is an adaptation of the price-earnings ratio and which measures valuation of a company's stock, or in this instance, an aggregate index, against a 10-year average and inflation-adjusted earnings figure. This is designed to smooth out any fluctuations to current earnings figures associated with a business cycle. As always, if there's any terminology used in this or any other discussions in the series which you'd like further explanation on, please feel free to get in contact with us. Hello, Peter. Thank you so much for sparing some time today. How are you doing?
I'm fine, thank you, Gordon. And I hope you're all well too.
Yeah, very good, thank you. Yeah. So, Peter, we've got a kind of a standard opening question to these discussions, which we've been asking all of the people that have come on, and it attempts to get a bit of an insight into you, really, or perhaps your kind of typical working week, or something that you've been working on recently. So we've had people share kind of anecdotes from a recent meeting or an article or book recommendation. Is there anything that you can share with us?
Yes. So, my working day starts actually, I suppose, with Bloomberg while I'm doing my teeth on the radio. And then I cycle in and I'm thinking about what they have said and any other news that's around. When we get to the office, there is always huge number of things to discuss, both macro for data we've had overnight, and any change of view that anyone has, and corporate news for any of our investments. So we're never bored. But with respect to books, we actually have a book club, Gordon, where once a month we get together and discuss a book that we have all read, which is, not to say we read other books, we certainly do. I'm currently halfway through volume 5 of Jonathan Sumption's 5-volume, each one of them, not far short of 1,000 pages, on the history of the 100 Years' War. So there's, I don't just read about economics, although I do read a lot of economics. But in the book club recently, we've read books just to give a long perspective. So they're 200 years apart. One was David Hume, Collected Essays. And if I can find it, I will just quickly quote one sentence from that. So the practice therefore, this is in mid-18th century, the practice therefore of contracting debt will almost infallibly be abused in every government. It would scarcely be more imprudent to give a prodigal son a credit in every banker's shop in London than to empower a statesman to draw bills in this manner upon posterity. And I don't think much has changed in the last 200 years. And the other book that we read recently was Free to Choose by Milton Friedman. So that was written in reaction to the disastrous inflationary splurge that we had, which Friedman believed quite convincingly was based on Keynesian economics. And he'd say he was taking the world forward and actually did have tremendous influence. And it's worth mentioning that because, in my view, there's an eerie similarity between the comments made by politicians and columnists and basically the consensus to the sorts of phrases that we used in the 1960s. And I suppose that's a normal cycle, isn't it? That you repeat what you don't remember.
Yeah.
And hardly anyone was around in the 1960s who's determining policy now. So I remember Reagan's great phrase that I'm from the government and I'm here to help is the most frightening set of words in the English language. And we're hearing it a lot now, aren't we? How governments are going to be in partnership and support various industries, industrial policies, it's now called. It used to be called picking winners. There's a very good reason it's not still called picking winners because none of them were. So that's what we've been reading. But,
yeah, no, thank you for that. No, there are two more good book recommendations. Yeah, we actually you very kindly sat in on a webinar we did. I was actually listening to it again a few years ago. This is during the pandemic. I think we were all at home at the time, and you referenced a book at that point, which is Charles Goodhart's The Great Demographic Reversal, which I still think is required reading for anyone that's got any interest in demographics and the impact that can have on economics. But we'll add those two new book recommendations to the list as well, I think. But Peter, I mean, talking of inflation and the kind of macro, I think as a first kind of proper question, it'll be great to just, I know it's a huge topic of inflation, but I wondered if we could kind of lay out your kind of current thoughts. I mean, inflation in the US and the UK has been a bit stickier than expected so far this year. We certainly, those kind of expectations for rate cuts are certainly moderated since what was it, December, January time. But we have started to see a bit of easing. The ECB, not 2-3 weeks ago, starting this cycle of easing. But I wonder, could you kind of lay out your current outlook for inflation? Because I think it just frames so much of the rest of the discussion, really.
Yeah. So I think that there's an important distinction to be made between the secular trend of inflation, which we believe to be higher, and the cyclical trend, which obviously at the moment is relatively depressed with a great deal of help from energy prices and the end of supply side problems with shipping. And as mentioned before, we actually do believe that this era is very like the 1960s. So what happened in the 1960s, if I can quickly review it, was if you take America, inflation was between 1 and 1.5 for the first 5 years of the 1960s. There was the budget was in balance and employment was full. Fantastic situation. But when Johnson came into the White House in unfortunate circumstances, he inherited the Vietnam War, but he also had a huge ambitions to do something for the poor. So this is a period, a so-called Great Society program, where Medicare and Medicaid were set up. And all these things are very expensive. And he did not feel able to tax the US population to pay for it. So the budget deficit got bigger as the 60s developed. And so that overstimulated an already fully employed economy. And the result of that was that inflation went up. It didn't explode. It went up by 1% a year. So by 69, it was 6 from that 1.5. Obviously, after that, it did explode and went very high. But I think that first period is the relevant one for us because we exactly the same. We do have an overstimulated economy. Even a mild recession seems to be unacceptable. Require further stimulation. But expectations remain very anchored. I would say that's my surprise, but they sure are. So as measured by break-evens on tips, the Fed will be very pushed to have inflation as high as its target. So I find that extraordinary, but that is the view. And while that expectation remains low, that's very helpful for inflation because it helps frame the development of wages, for instance. However, I think that expectation is based on a history which is no longer relevant. So you mentioned demographics, but the whole period from 2000 to 2020 had extraordinary deflationary forces globally. So demographics was one, globalization was another. So as China began to dominate the world of manufacturing. And technology also was helpful. So technology is always helpful because it's productivity, and productivity is terrific for containing inflation. But there was a particular thing from the internet where price discovery became much easier and therefore price competition much greater for consumers. And I think that was more or less a one-off. I'm sure it will continue a little bit, but more or less a one-off, that effect. So the long and short of it is we expect inflation to be higher, but to be cyclical, to cycle with the business cycle, and probably average 3 or 4 over the next few years.
Yeah, no, thank you for that. That's helpful in assessing it in context with a historical period as well. Yeah, thank you. Very, very interesting. I guess the next piece is kind of how you asset allocate against that backdrop, and I wondered if I could ask you to kind of summarize that in the next question. I mean, it's been kind of if we look back at those kind of last 2 years, it's been, I guess, characterized, particularly equity market returns, by very narrow breadth, a kind of very small group of companies leading equity markets higher, whether it be US outperformance as well, and generally equity valuation multiples expanding, particularly in the US. I guess given we talk very much about your kind of long-term value-driven approach, could I ask you to maybe summarize how you're currently allocating capital against that backdrop?
Well, the starting place is that we believe the world economy to be very fragile. And part of the reason for that is the levels of debt, which are truly extraordinary. The US and the UK are actually not the worst. Just enough, France has a significantly bigger debt problem than either of them. But they're still bad enough in both for us to have scares from time to time as to whether there will be buyers for enough debt to finance the large deficits which both countries are running. And I think of the debt as being unstable, but it's like a sand pile. You never know which additional grain will cause a problem. And there's no doubt that the Fed still stands with the Fed put. If they can rescue any situation, they've proved that several times in the last couple of years. And if you remember last autumn, there was a big sell-off in the US bond market. And the response was that the Treasury said they would sell less bonds, less long bonds. They would shorten the duration of their issuance. And the Fed also acted to contain the problem. So I think we know that there is an event, but the ability to do that depends on maintaining credibility. So if inflation at the time that you're doing it looks as though it's on an upward trend, that becomes much more difficult. So we think debt is a huge problem and could cause major corrections in asset prices, but we don't know when, and it could be a long time. We just don't know. And the other concern is that the valuation of the US market, so the US market as a whole, not just the magnificent 6 or 5, whatever they are now. So we pay a lot of attention to ratios like CAPE, which I'm sure your listeners know. So CAPE is at 34. It's been a little higher a couple of times in history, but it's a long, long way above most of its experience. And it's certainly significantly above what it was in 1929. And there is reason for that to become even more pertinent, because a couple of years ago, Schiller, who created CAPE, Robert Schiller, came out with a statement that actually, yes, his ratio looked alarming, but with interest rates at 0, he thought that was fine, that you would explain that. But interest rates are not 0 anymore. Yeah. And in our view, it is not a temporary phenomenon that interest rates are much higher. We think they will sustain it. And therefore, we think there is a potential for a very significant market setback in the US. Obviously, it's got tremendous momentum as we speak. So I'm certainly not trying to time it. And historically, we always have been early. So in the late 90s, we were underperforming a very strong market in the US. But we sailed through the crash of 2000 with an up year. Same thing in 2007, again early, but it all was rewarded when the crash actually came. Yeah. So for that reason, we have just 34% of our assets in risk assets. That number has actually risen a tiny bit. You might find it surprising if you have my previous code, but that's because investment trusts, which we will come to later, I'm sure, seem to us to provide excess returns over the markets in which they're invested. And that's very, very good news. I should mention that a lot of markets don't look anything like as expensive. In fact, essentially, America is unique in how expensive it looks. But the reason not to take too much comfort from that is just the history that when the American market crashes, correlations get a 1. You are not defended by being what seem to be much better value assets elsewhere. So let's say with 34%, we have a lot in index linked, and a lot in what we call dry powder. So that's very short term assets of one kind or another, which now produce very reasonable returns. So typically 5%. And that dry powder, just implicit in the name, is there to buy stocks when they're very cheap.
Yeah.
But we're not particularly tempted by very much at the moment.
Peter, I wondered if we could touch on the index-linked bonds element of the portfolio, because it is a notable allocation, and it is perhaps one element which is perhaps not as well understood as kind of more traditional elements of the portfolio. I wondered if you could maybe summarize you touched on kind of real yields in a prior question, but could you kind of summarize the current opportunity and also the role that you see that playing in protecting portfolios against certain economic scenarios from here?
Yes. So we divide our linker holdings into two. So the first part is those short linkers, which essentially give you inflation plus whatever the yield is. So in the case of the UK, that's about 1.3 at the short end. And it's about 1% higher than that in the US. And in the UK, that's on a break-even of 3.6 on the RPI, which is roughly where economic forecasts have it. So it's more or less in line with where forecasters have the RPI in the short term. But we think over time that will get higher. But it's a really attractive situation to be in, that you can have a nice guaranteed return with really very little risk. Unlike much of the previous 15 years, when you had to accept negative yields if you wanted to be cautious. And so we have a good chunk in short UK, basically only in short UK. We have a little bit of very long stuff we bought in the middle of Trust-Mageddon, and that proved to be very satisfactory, but it's not large. And then we have about 8% in long tips. So the yield there, as we speak, is 2.27, and the break-evens are 2.33. So the break-evens is the implicit forecast. It actually is a little more complicated now, but let's call it the implicit forecast of what inflation will be over the life of the bond. And 2.33, I think, is very low, because the Fed targets the PCE deflator to be 2. The PCE deflator typically is about 0.35 below the CPI. So that suggests that the CPI target for the Fed is 2.35. And so what that's saying is that the Fed will meet its targets for the next 20 years, whatever. For the reasons we went into above, we think it's exceptionally unlikely that they'll be able to achieve that. But that's where we are. The attraction of long tips is, for us, is that they have a role in the portfolio, because historically they have been tremendously helpful to us in downturns, because they go up. They are a place to hide. And typically the dollar also catches a bit in those crises. And therefore it's been very, very helpful. So although the yields are perfectly decent, and if you hold them for 20 years, I think that's a perfectly satisfactory return, we are quite cautious about nominal bonds, which look to us to be quite aggressively priced. So if you think of inflation on the scenario that are somewhere between 3 and 3.5, and somewhere between 50 and 100 basis points for short rates over inflation in the absence of crisis, and then 100, 150 basis points term premium, which would be normal in the past. You've got yields which are significantly above the 4.5 where we are today. So that's why we only have 8% in the long tips. We do run a linker fund, a US tips fund, for anyone who wants to take their own insurance out in the same way. But it's done without the expectation of huge returns in the short term.
Yeah, sure. No, but clearly an attraction there in preserving capital. Yeah, no, thank you for that. Peter, I can't not have you on and talk about the investment trust sector at the moment. I mean, capital gain trust is quite commonly used investment trusts to gain exposure to certain areas of the market and certain asset types, but we're clearly going through a fair few headwinds at the moment within that London listed sector. We've seen discounts widen. There's just far greater scrutiny at the moment, rightly so, on kind of governance and capital allocation decisions, and we're starting to see a fair few bit of corporate activity in this space, kind of week to week these days. Could I ask you to summarise your thoughts at the moment on the sector? And you referenced earlier that it is presenting opportunities, but I wondered if you could kind of summarise kind of where you're seeing those and current thoughts.
Yeah. So just to give a bit of background, in November 1999, the law changed, which allowed after that boards to buy back freely to reduce discounts or eliminate them. But for quite a long time, very few boards took me notice. They would always say it makes it just smaller and that can't help and so forth. But I detect a really major change in the last year. And as you said, we won't go into all the regulatory reasons why the investment trusts have been out of state. But whereas 2 years ago we could not find almost any trusts that were of particular interest, today there are lots. And we get quite involved with boards discussing what they might do, usually not publicly. Although there was one exception recently, which is the trust that you had on, I know, yourself, which is Smithson. So Smithson had a clause that they would hold a vote if their discount was over 10% in their perspective. Actually said they will consider holding a vote, but it was very clear that still. Their discount did indeed exceed 10 for the relevant period. But they did put out an announcement that they wouldn't hold the vote. We are very keen that investment trusts do what they say they're going to do. So we were quite cross about that. But to be fair to Smith, they responded terribly well. So, first of all, they did hold the vote. We did not want it to wind up, by the way. It was a wind up. We did not want it to wind up, and we voted to continue it. We just think it's really important that trusts do what they say they're going to do. After all, they're called investment trusts. Who's in the name? But I have to say they are behaving really well now. So this is a trust which is buying back at roughly just over 20% annual rate in the last quarter, and it's really very impressive. One feature I would mention for trusts generally is that boards usually very much underestimate the natural rhythm in demand and supply for their stock. And if they had experience of open-ended funds, they would see that actually, even successful ones, not beginning ones that aren't, but even successful ones have periods when they have to redeem quite a lot of the units in the case of an open-ended fund. And so boards have been very unaware, I think, of quite how much they need to buy that to make a difference. And that explains the canard, which I know is put forward by a lot of people, including some of the advisors from investment banks, that buying back stock doesn't make any difference to the discount. And it's perfectly true. If you make a token gesture buyback, then it doesn't. If you do it vigorously enough, then it sure does. And in fact, I think we can prove that with capital gain trusts, which is buying back. So we listed about just under 1.2 billion in the last 8 years, and bought back about 270 billion. So you can tell that these are big sums. Anyhow, Smithson is now, we think, in a really attractive situation. So I'm pretty sure, as mentioned by your correspondent from the trust, that they will vigorously buy back stock until the discount is at least in single figures, and they certainly have ambitions to make it much less than that. So while they're buying back, if they buy back, they spend back 20% of the portfolio. I obviously buy back a little more than 20% of the stock. Then at where we currently are, the 12 discount this afternoon, then there's a 13.6 return on that immediately with upwards. And if you annualize that at the rate they're buying back now, it adds about 2.7% to the NAV. So we've got a trust which is actually a very good example of what we look for. So we think it is well run. We think it's in an area we're quite nice in exposure. So we do think small to medium companies are very attractive within the context of the world markets at the moment. And we're going to make a bit extra from the buybacks, and we're going to make it a bit extra reasonably confident from the discount coming down. So that will be great. So another example would be Breton Howard. So Breton Howard is a hedge fund, well, a feeder fund into a hedge fund. It trades currently on about 8.5 discount, so it's actually up quite nicely today. It's very defensive, so we expect it to do best when markets are weak. So obviously, given our concerns, that's very helpful. But again, they have a slightly inflexible system, so it's quite difficult to raise money immediately from the hedge fund. It takes a bit of time. And because of that, they got slightly caught out, and the discount went up to 18 at one stage. So that was a terrific opportunity to buy. But actually, I think they were very good at 10, at actually 8. I think they're still fine. I did have some others, so I realized that I brought it right on time.
No problem. No, there's some good examples there. Yeah, we interviewed Simon Barnard from Smithson. I think it was episode 12, I think. So we discussed some of those capital allocation decisions directly with him, so listeners can go back and listen to that if they wish. But Peter, we're actually we're recording this interview a day before the UK general election. But I wondered if I could kind of ask you about kind of how the elections of this year are kind of are changing any elements of your outlook. I mean, we could potentially have a change in government in both the UK and the US potentially this year. I mean, is there anything that's kind of that you've seen in whether it be kind of manifestos that have been published in the run up to this election that have kind of leading you to change the outlook at all?
Well, the first thing to say that actually is rather a dishonest election, isn't it? Because both major parties pretend that the OBR forecasts for the deficit are reasonable. We all know that they are not, because the OBR is required to assume cuts in all sorts of public services that are already struggling. So we know that public expenditure has to be higher than is invested in those forecasts. But having said that, there's definitely nothing to break in the losses in the Labour manifesto, which is practically the only one that matters at this stage. But that's partly because there's nothing in it at all, very little detail about anything. And I do think that there's a gamble here. Rachel Reeves has bet everything on growing, improving. So the OBR is forecasting somewhere around 1.6, 1.7 for next year in growth. That's actually been the high end of the range by forecasters. They think they're going to get 2.5. I mean, there are some things that they have promised to do, like free up the housing market and possibly address universal credit, although that's very softly spoken. which definitely could make a big difference to growth. But I'm pretty sure it won't make a difference in 2025. It'll take quite a long time to implement. So without going into detail, as I say, I think it is a bit of a gamble, because if they don't get that growth, then they've got a very big deficit, and they will have to deal with it either by raising taxes or cutting expenditure. And with the sort of majority that they have in prospect, the likelihood of them being able to cut expenditure, I think, is very modest. The opposition will not be opposite to them; it will be alongside them. So just very quickly, I think France is much more alarming, actually. So we haven't got time to go into the nuances of France, but because they start off with such a bad debt situation to begin with, and they need to have a budget to cut expenditure quite a lot to conform with the debt procedures of the EU. So if a frozen government, one which has paralyzed, obviously will lead to very large deficits. We would not be able to pass that such a budget. So I think France is more alarming, and the US is really very simple. That if the Democrats, whether it's Biden or not, get in there, presumably we carry on much as we are now, with hugely excessive deficits, fiscal deficits. With Trump, thought is that you get those plus a few tax cuts, so even bigger deficits. So that's where we're on that.
Peter, we've got a standard opener and a standard final question to these discussions, and we've had several different portfolio managers on these calls, a lot of kind of equity portfolio managers. But the question that we ask at the end is for them to highlight one particular area that they're particularly high conviction in at present. And I am fully aware that the kind of capital gearing trust philosophy is one of kind of asset allocation. So it's the kind of power of the portfolio all working as one. But I wondered if there was one area. I know you had a couple that were on your list that you didn't say in a previous question. But was there one particular area that you might highlight that could answer that question?
Well, I thought about this question a lot, and as you say, I tried to choose. But we actually recently set up a fund to express this idea, so perhaps it's just worth mentioning, which is that given the huge uncertainties there are in the world and in the UK, I do think that the ability to get a very certain return after tax and after inflation in short UK index linked is very attractive. And I worry about ISAs. So ISAs seem to fall into two camps. There's those that are entirely in cash, which is unfortunate. But most of them seem to be entirely in equities. I would encourage people to buy this fund. We set it up because we looked at the ETF, and the ETF is incredibly volatile because it's very long, reflecting the nature of the UK linker market, and really not suitable for anything that can be thought of as a defensive investment. So the duration of our fund is 4 and 5 years. It's very cheap, 24 basis points, the total costs, total charges. And I think that everybody should have something in it.
No, that's been very clear as we've talked through the inflation outlook. But yeah, no, thank you for that. Peter, it's always a pleasure to get your thoughts. Thank you so much for sparing some time today. Thank you for listening to the Investor Insights podcast, hosted by Killik Co. You can get in contact using our podcast email address, investorinsights@killik.com, for more information on any of the topics discussed, or for further details on the services offered by Killik Co. This podcast is not personal advice. The content is intended for educational purposes only and is not investment research or a recommendation to buy or sell any financial instrument or product, or to adopt any investment strategy. The value of your investments can rise as well as fall, and you could get back less than you invested. Past performance is not a guide to future performance. The investments referred to in this podcast may not be suitable for all investors, and you should seek advice from a qualified investment advisor. Killik Co is authorised and regulated by the Financial Conduct Authority, the FCA.